Hello, good evening, and welcome to my weekly webinar on technical analysis and trading techniques. Today, we're going to be talking about the 1-2 trading strategy. It's a break and retrace type trading strategy used mainly for capturing profits during a trend, but also it can be used for topping patterns and trading ranges as well. Okay, so here's the outline of the presentation. I'm going to be talking about market traps quite a bit. What are market traps and how do they form? If you've seen any of my previous webinars, you'll notice that I use trap, break and retrace methodology in a lot of my trading strategies, and this week's one is no different. So I'll explain how break and retrace works, the methodology behind it. And then I will introduce you to the 1-2 pattern or trading setup, which I use for identifying trap situations, which can give you good entry into a trend, an existing trend. I'll talk about the orders that I use in trading, and then I'll go through the trading strategies that can be used to benefit from the 1-2 trading setup. I'll summarize, and then I'll talk a bit about money management. And at the end, if there are any questions, then I'll be very happy to answer any questions that you may have. Okay, so let's start with the concept of the market trap and my break and retrace trading methodology. So what underlines it is the fact that many of the big moves in the markets that one would like to benefit from in terms of trading tend to occur after a false breakout of some kind. And I call these setups market traps. So traps form when traders are caught on the wrong side of the market. Usually, they will form after a technical move, for example, the break of a support level or the break of a resistance level. And often they have a fundamental trigger, for example, a news move. And I covered the news trap last week. I talk about that setup as well on a regular basis. So I've developed a trading methodology, which I call break and retrace, to capitalize on market trap setups. So this is the how the buy example looks, the long example. So what happens is the market starts off at a fixed point. Then something hits the market in terms of either a piece of news or the market breaks through a support level. And then you get this big movement to the downside, which I call the break. Okay. Now, usually after the break, the market then goes a little bit sideways, and then a bit of profit taking ensues, and then we see another push to the downside. But in this case, what I'm looking for is for the market to see the break move, and then for the market to start to retrace higher. And when it gets to a certain point above the origin of the move, then we know that all of the sellers, based on the break, are trapped. And that creates a situation where the market, positioning-wise, should go higher. So in the technical trap, break and retrace situation, the break is the situation where the market breaks below a support level or above a resistance level. So if the move fails to see follow through buying or selling, those who bought or sold on or after the break will start to exit their losing positions. And that's when the retracement starts to occur against the break move. So we know that when the market goes all the way back up to the start of the break move, then a trap has formed. And then we can expect a big move in the opposite direction to that of the break. So with the 1-2 example or setup, what we've got here, this is the bullish setup. So it forms when the market has a strong move up, and usually involving several thrust bars where the close is above the previous bar's high. And then the market starts to see a bit of a correction. And this is defined as the market breaking through the previous bar's low and leaving behind a lower high and a lower low on the chart. Okay, so we've got a move to the upside, which is the trend or the momentum. Then we get a correction to the downside, which results in the break of the break and retrace setup. Okay, so after that move to the downside, the market fails to sustain it and the trend buyers come back in. Then we start to get the retrace in the direction of the main trend. And then before you know it, we have a resumption of the uptrend within a few bars. Let's take a look at how the pattern works. So we start off in a situation where the market has made a big move to the upside, or a trending move, higher highs and higher lows. But whatever this line represents, at the end of it, everybody is bullish and we're looking to buy the dips. Okay, so that's essentially the setup which gets us onto the long side. But we don't buy the market until we've seen the qualified correction. And that qualified correction comes in the form of the 1 to the downside and the 2 to the upside, the 1, 2. So what does the 1 represent? The 1 represents breaking through the previous bar's low and also forming a lower high. So we've got ourselves a lower high and a lower low. Okay, but this is the first time in the sequence. So if this bar also happened to be a lower high and a lower low, it wouldn't count. What counts is the first push to the downside. So this is the break of the break and retrace, which traps some of the sellers who are selling into this market. So we get the 1 to the downside, which is the lower high and the lower low. And then what we're looking for, a clear sign that the trend is resuming, is the break through the highest high for the last 2 bars. So essentially, once you've got your break to the downside, the number 1, we draw a line at the highest high for the last 2 bars. So at the end of this bar, the 2-bar high is here. But at the end of this bar, the 2-bar high has come down from here to here. So the 2-bar high is your trigger to buy the market. Okay, so once we've had the 1 to the downside, and then we have the 2 to the upside, we break through the 2-bar high. That's our trigger to go long. Okay, so let's see a few examples of the bullish 1-2 pattern in action. Okay, first chart is Euro Yen, a daily chart of Euro Yen, and it starts off in a bullish situation. So we can see that these are daily bars. So we can see that the Euro Yen is closing above the previous bar's high, closing above the previous bar's high, aggressive demand. So 1, 2 days in a row where the market closed above the previous bar's high. So pretty good bullish momentum in terms of the way this market is going. So what we want to do is we want to buy the market, but we don't want to buy it as the market's doing this 1, 2, maybe 3 days in a row to the upside. We want to see a correction to the downside. So that comes in the form of the 1, and then we get the 2 for the signal. So the 1, if you recall, is a lower high. This high is lower than this high, and a lower low. This low is lower than this low. So that is the 1 of the 1-2 situation. So the break of the break and retrace. Okay, so once we've identified the 1 down, we're now looking for the 2 up. So the 2 up comes, we draw a blue line, or any color line you wish, at the highest high for the last 2 bars. So at the end of this bar, the 2-bar high is here. Okay, so the next bar comes along. So on this bar, we can buy it here, but it doesn't actually reach that point on this bar. So at the close of this bar, the 2-bar high has come down from here to here. So this is our trigger, buy trigger for the next bar. Next bar comes along, we can buy the break of this high, and we see a nice push to the upside. 1, 2. 2 consecutive thrust bars to the upside. You'll notice, or one thing I've noticed in studying this market action for the last 30 odd years, is when the market trends, what you'll see is a lot of these consecutive thrust bars, where the market closes above the previous bar's high, which indicates aggressive demand. So usually you'll get 2 or 3 in a row before the market corrects. So 1, 2, market pushes and then starts to correct, boom, corrects lower. Then the trend resumes, 1, 2, then it corrects lower. So there's this kind of natural rhythm that goes on with these bar charts. and candlestick charts if you like to use them. Okay, another example, Kiwi dollar, very similar to the last example for euro yen. So we start off with Kiwi making at least 3 consecutive up closes, 1, 2, 3, another sign of aggressive demand. And then again, we're bullish based on the formation that we've seen, but we want to see a correction before it's safe enough to buy into the market. So that correction comes on the breakthrough support here, lower high, lower low. Okay, so at the end of this day, Kiwi dollar has made a lower high and a lower low. So people have been selling it on this day, thinking that the market has topped out and is going south. Okay, but we know that the trend momentum is still positive, but we can't buy it until we get the breakthrough the 2-bar high. So at the end of this bar, we draw our blue line here. This is the highest high for the last 2 bars. Next bar comes along, we break it. So that's the entry point for the long. Boom, boom. A nice double thrust to the upside. 1, 2. 2 consecutive days where the market closes above the previous day's high. And at the end of a double thrust, it's not unusual to see the market start to correct the other way. So a good time to take your profits after the break and the exit, like that. Okay, dollar yen, few examples here on the same chart, daily chart. So the market starts off again by trending higher, higher highs and higher lows, a nice double thrust here, 1, 2, turn. And then we get the lower high and lower low. We draw the blue line at the highest high for the last 2 bars, which is here. On this bar, we break it, boom, 1, 2. 2 consecutive days where the market closes above the previous day's high. After the second one, time for the turn. Market turns down, corrects. We're still bullish, but we're waiting for the 1 down, which we get. Lower high, lower low. Draw the blue line at the 2-bar high. Initially, it's here, but at the close of this bar, it's come down to here. So on this bar, we can buy the break. Here, boom. Nice, good, a good day there for the day trader, and then it turns on the next bar. Bit of sideways chop. Market makes a 1 down and starts to see nice 1-2 action to the upside here. So a number of opportunities here to buy the breakout based on the 1-2 pattern. Another one here, this is a monthly chart of euro dollar. So this thing works quite well, this market structure thing works quite well on most time frames. So monthly, in this case, we've got euro dollar way back when moving sideways. We get a 1 down here where it makes a lower high and lower low. The first time in the sequence, not this time, this is the second time in the sequence. This is the first time in the sequence here. Lower high, lower low, make the blue line above the 2-bar high. At the end of this bar, lower the blue line to here. So this is now the 2-month high. On this month, we can buy it. Up it goes like a rocket. Boom. Nice break to the upside. Same again. Lower high, lower low. Blue line at the 2-bar high. There's a breakout. 1, 2. Double thrust. Corrects lower. Lower high, lower low. Number 1. There's the 2-bar high. Little bit of positive price action, but not a particularly good one. And then we get another 1 down. And then this is where the real signal comes here. Boom, boom, boom. A nice triple thrust actually here in one of the best parts of the move. Again, we're still bullish, but we need to see a lower high and lower low, which we get there. Draw the blue line at the 2-bar high. There's the buy signal there. Boom, boom. Shake the room. Okay, final one here. This one turns out not to be a great one because we pushed through. Maybe we might have made a little bit of money from a short-term perspective, but by the close of the month, it closed quite weak near the month's lows. So that would have been a losing trade, but that's okay because you have all these winning trades along the way. Okay, this is drilling down to a 15-minute chart. So just to show that the setup works quite well on smaller, shorter term charts. Well, the best chart I would say to use it on would be the daily, in my opinion. But yes, you can use it on some of the intraday charts too. In this case, cable is trending down, and then it has a push down to the downside. It makes a lower high, lower low. There's a 1 down, and the buy trigger comes in there at the 2. So nice double thrust there. There's a buy example there, and here a pretty good one where the market makes a lower high, lower low, the first time in the sequence, and then within a couple of bars, we break through the 2-bar high, trapping these sellers. That's essentially what you're looking for with this pattern. You're looking for break and retrace to the upside. And before you know it, this trend is resuming with a vengeance. Okay, so that's the bullish setup. So now let's talk about the bearish 1-2 pattern or setup. So the bearish setup starts with the market typically trending down or seeing a sharp decline. And obviously, you can spot this by looking at the daily bars if it's a daily chart, because many of those bars will be seeing thrust bars where the close is below the previous bar's low. Okay, so we start off by seeing some aggressive selling. That gives us our bearish bias, but we don't want to sell the market just because it's going down. We want to see a correction. We want to see some buyers come in, trap themselves, and that gives us the fuel for the market to go down even further. Okay, so the correction starts when we break through the previous bar's high, leaving behind a higher high and a higher low. That's our 1 to the upside from the 1-2 pattern. Okay, break and retrace. So the market breaks to the upside, and then within a couple of bars, the market starts to retrace to the downside. Once we get the break to the downside, the downtrend can typically resume. So here's the explanation. This is the chart. So the market is trending down. So this gives us our bearish bias. Okay, so now we're looking to sell, but only once we've seen this 1-2 break and retrace set up to the downside. Okay, so the market swings to the downside. It then breaks through a previous bar high, making a higher high and a higher low for the first time in the sequence. So there's your 1. So we draw the blue line under the 2-bar low. Okay, on this bar, it doesn't break down. So we can now move the blue line from here up to here, because at the end of this bar, the 2-bar low is here. That's where we sell it on the way down. So we sell the break of the 2-bar low, looking for the market to break down. Okay, so let's see a few examples of the bearish setup. Okay, so this is Aussie dollar. It starts off by trending lower, big down day here, bit of a turn. Then the market starts to push higher, but not in an aggressive fashion. So this is the 1 to the upside. So this is the first higher high and higher low within the sequence. So that's the 1 to the upside, and that gets us ready to take a stab at the short side once we get that 2-bar low. Okay, so there's the 1, and then it doesn't happen on this bar, but it happens on this bar. So we break through on this bar, the 2-bar low, we sell the break of the 2-bar low, and we get a nice 2 days in a row where the market thrusts, closes below the previous bar's low, 1, 2 in a row. 2 consecutive thrust bars to the downside, time for the market to turn, which it does. Okay, now this one on DollarCAD actually occurred as part of a top. So as I mentioned at the start, that most of the time these will be trend continuation patterns or signals, but sometimes you'll get a good 1-2 at a market top or at a market bottom. And in this case, what we're seeing is a good 1-2 sell at a market top. So this one started off with dollar Canada trending higher. So we're kind of bullish. We're actually waiting for the market to correct lower, which it did, but we're looking to buy the 2-bar high, but we do not get it. What we get instead is a 1-bar high. We break through this high. This is the highest high for 1 bar. That's the highest high for 2 bars. We don't get it. So the market pushes higher, but does not break through the 2-bar high. Okay, so that's a bit of a warning sign if you're bullish. So, but what we've done here is we've set ourselves up for a sell. So we've gone 1 to the upside, higher high, higher low. And now we can sell at the 2-bar low, which is there. An amazing day on the downside. So after that big aggressive down day, the market corrects higher. Okay, this is euro dollar on an hourly chart. So we start off with a bit of a sideways range, sideways to higher. We get a 1 to the upside, and within a couple of bars, we're breaking down through the 2-bar low. So the market starts to trend down a bit. 1 to the upside, higher high, higher low. Sell the break of the 2-bar low. A couple of down hours there. So if you're a day trader, there may be opportunities here to make 10 or 15 pips on the way down. Then we get a big bounce, and then we get the 2-bar low here. Sell, aggressive selling into the close. Okay, again, euro dollar, but this time a daily chart. I mentioned that daily charts tend to be the best because they're a lot smoother than particularly the intraday charts. And there's much more opportunity in terms of pips on offer. So euro dollar starts off by doing 3 consecutive closes to the downside. Nice aggressive, semi-aggressive selling. Then we get the push to the upside here, which makes a higher high and a higher low the first time in the sequence. So that's our 1 to the upside. We draw the line under the 2-bar low, which is here initially. Next bar comes along. We don't break through the 2-bar low on it. So we can raise the 2-bar low from here to here. This is where we sell it on this bar. Market sells off aggressively to the downside. A lot of opportunity to make money here. A double thrust, 2 consecutive closes under the previous day's low. Time for a turn. Again, we are bearish. We're looking for the market to push higher. Higher high, higher low. Sell the break of the 2-bar low. Nice down day there. Bit of an opportunity there for the day trader, I guess. Then the market corrects back. Higher high, higher low. Within a couple of bars, the market's breaking down again. There's the sell. Nice aggressive selling here. One more example here. And then there's a sell there. Okay, so just to show you a few examples of buys and sells on the same chart. Okay, so this first one is euro dollar cable sterling dollar weekly, and we've got initially we've got a buy example here. So what we've got is the market. It's kind of, we had a big weekly range here, an inside weekly range here, another inside weekly range there, and then the market tries to break out of the inside ranges. So we get this lower high, lower low. Okay, that's the first time within the sequence, the first one, lower high, lower low. So we draw our blue line or red line or whatever color line you like at the highest high for the last 2 bars, which is here. On this bar, we can buy the break of the blue line and up it goes for 2 consecutive weeks. 1, 2. Nice, again, a nice double thrust to the upside. And again, as I mentioned, very often after a double thrust, the market likes to take profits, turn. So 1, 2, turn. So not a bad time to take your profits if you happen to be long after a double thrust. 1, 2, turn. Okay, so we see a double thrust. It makes us a little bit bearish in the short term, but bullish in the long term. So we wait again for another opportunity to buy the market, and we get it here. Lower high, lower low. That's your 1 down. Draw the blue line at the 2-bar high. We get the break here within a couple of bars. Not a bad opportunity there for the multi-day trader. Then it turns and tops out. Bit premature, but they don't all do what they're supposed to do every time. Okay, after a bit of chop, we get a good opportunity here. The market makes a higher high and a higher low, first time in the sequence. It likes to do this kind of false break of inside bar. That tends to occur quite a bit where this 1-2 comes in, where the market makes an inside bar and then breaks it one way, and then the next bar you get the real break, which we had there and here. So there's the fake out, higher high, higher low, break through the 2-bar low, which is also the inside weak low, double thrust to the downside, boom, boom, exit. Double thrust. So nice double thrust to the downside. market likes to turn after a double thrust. Okay, this one is gold futures, daily chart of gold futures. You'll notice here there's a bit of a gap. This is because it would have been a holiday, looks like Easter on this time. So we had this break to the downside, which is the 1. And then we have a 2-bar high here. So 1 to the downside, and then we get the break of the 2-bar high here. That's the buy trigger. Boom, boom, double thrust, top, turn. Okay, so then the market is trending down. Again, you'll notice 1, 2, close under previous bar's low, close under previous bar's low, double thrust, turn. Market tries to go higher, higher high, higher low. We're selling the break of the 2-bar low, which is there. Boom, 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 triple thrust. Don't often see triple thrusts, but nice when you do. Market turns again, and we're still bearish. We've got a higher high, higher low. We're now looking to sell the break of a 2-bar low. We get the push to the downside. On this bar, this is when we get a marginal 1-2 to the downside. We actually get trapped ourselves on this one. This is where we get stopped out for a small amount of money. But we've done quite well on these trades, so not the end of the world. But the good thing is, what we have here is, although this is a 1-2 sell to the downside, we've actually got a 1-2 buy, because this makes a lower high and a lower low. First time in the sequence, we get a buy trigger here. So we sell it here, we get stopped out, but we can buy it here because we've got a buy signal. So up it goes like so. Market's trending higher. We're bullish. We're waiting for a buy signal. Market makes a lower high and a lower low. We get a breakout here. Maybe a small amount of money there we could have made on the upside, and then it tops out. Okay, dollar yen daily, some more examples both ways. Here the market is bearish, double thrust, close under previous bar's low, close under previous bar's low, 1-2, time for the turn. Market pushes higher. There's the trap, higher high, higher low. We're selling the 2-bar low. It occurs here, boom, 1-2, double thrust, close under previous bar's low, close under previous bar's low. So nice opportunity there. As I say, the market likes to try and turn, take profits after a double thrust. As it did here, it did here. Market turns. Okay, so now we have ourselves a new bullish sequence here. Close above previous bar's high, close above previous bar's high, double thrust, turn. Okay, so you'll notice there's that rhythm. There tends to be a bit of a rhythm in a lot of these markets where we get this two days to the upside or downside before the market likes to turn and take profits. Okay, so we're bullish at this point. We get a lower high and a lower low. We're looking to buy the break of the 2-bar high within a couple of bars, and we get it here. There's the buy, double thrust again, 1-2, turn. Okay, so we're waiting for a buy opportunity. The market corrects lower, making a lower high and a lower low. So we are buying the break of this high. If we get it, we don't. On this bar, the market pushes through yesterday's high, but cannot push through the 2-bar high. So there's not enough momentum to push this market to give us a buy signal. And by the close of the day, the market is in the lower half of the range. Okay, so now we set ourselves up with a 1 to the upside. Higher high, higher low. We can sell the break of the 2-bar low, which happens here. And down we go. Okay, euro dollar hourly chart. So we start off just by going sideways here. Then we get a lower high and a lower low here. That's a 1 down. Start of the European session, which means we can buy the break of this high here. We buy the break here, and we get a nice double thrust to the upside here. So a nice opportunity here for maybe 10, 20 pips on the upside. Then we get the correction. Lower high, lower low. We're waiting for the 2-bar high, which happens here. Buy it in here. Lovely double thrust to the upside. 1, 2, time for the turn. Okay. Then we get the pullback. We're still bullish, trending higher. Get the pullback. We're looking to buy the break of the 2-bar high. It doesn't happen on this bar. And again, we've got ourselves a 1 to the upside because we've got a higher high and a higher low, which means we can sell the break of the 2-bar low here. Down it goes. Okay, so that's pretty much how the 1-2 setup works, and a lot of different examples, buy and sell, most of which you've seen work in terms of trends, but also some topping situations where we get a 1-2 situation at the top or the bottom of a trend. Okay, so before looking at trading strategies based on 1-2, I want to say a little bit about the market orders that I use to enter and exit the market when I trade 1-2. Okay, so I'm sure everybody is familiar with the stop and limit orders. They are the common orders that one would use when trading. So when you place a trade, you protect yourself with a stop order, and when you want to take profits, or maybe even you want to buy the market, if you want to buy the market lower down, you'll use a limit order. But the third one, which not many people tend to use or even talk about, is the time exit. So what is a time exit? The time exit is an order which gets you out of the market after a certain time period has elapsed. So as an example, you could say, right, I'm using a daily chart, I'm buying, but I want to be in this trade for no more than 3 days. So the order would be exit at the market at the close of 3 days after being in the trade. So I use those quite a bit when it comes to trading, because momentum is kind of, it ebbs and it flows and it comes and it goes, and you know what is hot today is not tomorrow. So it's good to recognize that momentum has a kind of pendulum quality. You'll notice this double thrust, and then it turns, and then you get another push. So the idea would be to get out before the market momentum can turn against you. That's why I use time exits with my trades. So just to kind of refresh, I'm not too sure whether you need refreshing, but just to refresh on stop orders. So a sell stop order is an order to sell below the current market price. So effectively what you're doing is you're selling into market weakness. So if you're using a stop to enter a trade, you are selling low, looking to exit your short even lower. So sell stops are used for entering short positions and exiting long positions, most of them losing positions. A buy stop order is an order to buy above the current market price. So what you're doing is you're buying into strength. Buy high, exit long, higher. So why would you want to buy above the market? Well, you'll be using a buy stop to get you in. For example, if we're using a 1-2 buy situation, the 2-bar high, you will not be buying before you get to the 2-bar high. So you'll be placing an order, a stop order, to get me into the market if we break above the line. Okay, limit orders, just to recap, a limit order, a sell limit order, is an order to sell above the current market price. So what you're doing is you're selling into market strength. Buy limit order is an order to buy below the current price. You're buying into weakness. So when and why would you use limit orders? You would use limit orders to enter if you wanted to get in at a cheaper price, but I don't do that with most of my strategies and systems. For the 1-2, I'll only be using limit orders to take profits. So again, time exits get me out of a trade after a certain time period has elapsed. So as an example, you could say, well, I'm using an hourly chart. I'm going long. I want to be out of this trade within 3 hours, or at the end of 3 hours if I don't hit my target or I don't get stopped out. Same thing on a daily chart, get me out after 4 days, that kind of thing. So the idea is that you are reducing your risk. Okay, because obviously, as I say, momentum can turn very quickly. These trading strategies are based on going with market momentum. Yeah, the idea is you're using market momentum to give you the impetus to say the market is going in this direction. I want to join it. So that's essentially what you're doing. So you use a time exit to reduce risk, hopefully getting out of a position before momentum can turn. Okay, so let's talk about the buy setup for using the 1-2 strategy. Okay, so how does it work? First thing we want to do is we want to observe a sustained move higher. So that can be basically a trend, higher highs and higher lows on a chart. You could identify it as the market holding above a certain moving average. You could identify 3 consecutive closes to the upside, a double thrust, a triple thrust, lots of things you can use to identify market strength. Okay, so once you've done that, that gives you the bias to buy the market, but only after the correction. Okay, so how does the correction unfold? If you recall, it unfolds as a lower high and a lower low. Okay, the market needs to make a lower high and a lower low, which means that on that particular bar, whether it's a daily chart or an hourly chart or a monthly chart, on that particular bar, the majority of people were selling the market. Okay, and that sets the trap. That's what gets us ready to buy the market, but only when we can break above the 2 bar high. Now you'll notice I put next 3 bars in here. So typically, most of these, the best ones tend to occur after 1 or 2 bars. Sometimes the 3 bar can work as well. I like to give it 3 bars just to catch all of them if I can. So what I'm doing is I'm identifying the break to the downside, and I'm putting a buy stop for 3 units just above the nearest 2 bar high. And that is my entry trigger for the long trade. Okay, so if I happen to go long, I need to protect myself with a stop loss. Where do I put my stop loss? Well, typically I will put my stop loss below the lowest point of the correction. So in other words, below the low of the 1 bar, the lower low and the lower high bar. You could also use a tighter money management stop if that distance is too big. And with regards to, we'll come to profit targets a bit later in a minute, but with regards to the time stop, I use what I like to call the Brexit exit. So a bit of a catchy word there because obviously Brexit's in the news, but it helps me. It helps remind me of when to get out of the market. What does it look like? So for a long example, the Brexit exit looks like this. So this is the setup. Market swings to the upside, which puts us on the buy side of the market. Market corrects to the downside, making a lower high and a lower low. That's our 1 down. Okay. Now we buy the market, if you recall, on the break of the nearest 2 bar high, which happens to be here. So 1, 2, that's the highest high for the last 2 bars. That's where we buy it. So we buy the market, we've got targets along the way, and the time exit is basically break and exit. Okay, so we exit 1 day after the break day. So there's the break of the 2 bar high. We're in that day, we're not getting out, maybe we're getting out at partial profit targets, but we hold the rest of the position until the close of this day. So break and exit, Brexit. Okay, sell setup, basically we just flip the buy setup the other way around, and it works like this. We need to observe a sustained move lower, which makes us bearish. Could be a series of lower highs and lower lows, could be 3 consecutive closes to the downside, could be close settling below moving average, could be triple or double thrust. Whatever measure you use to define a bearish environment, that's what you should use. Okay, so that's that gets us on the bear side of the market. Now we're waiting for the break and retrace. Now the break comes with the higher high and higher low bar, the 1. Now we're waiting for the break of the nearest 2 bar low, the 2, 1 and 2. So how do we trade it? We're putting a sell stop for 3 units below the 2 bar low. Okay, so when we break the 2 bar low, we're going short, and we need to protect ourselves with a buy stop, usually above the high of the correction so far. Again, we could use a tighter money management stop if that distance is too big. And of course, we need to get out on the Brexit time-based exit. So here's our swing to the downside, which defines the trend or momentum. We're waiting for our correction to the upside to set the trap. And here it is, higher high, higher low. We'll draw the line, the blue line, under the 2-bar low, the nearest 2-bar low, which initially is there, but at the close of this bar, it's there. It's gone up from here to here. That's where we sell it. That's the entry point for the short. So we sell it, down it goes, and we look to get out on the close of the second bar, the bar after the break. Break and exit, Brexit. Okay, so just to summarize, 1-2 patterns often form during strong trends both up and down. They can also form as part of a basing or a topping process. So the disciplined trader, if you're a swing trader and you're waiting to find a good entry point to jump into the trend, good to wait for a 1-2 setup before taking a stab at the trend. As I mentioned, the 1-2 occurs on various time frames and various markets. So it's quite good on all kinds of time frames and markets. But as I mentioned, the daily time frame tends to be probably the best one because the signals are a lot cleaner. They last a bit longer, and it's I'd say they're a lot more reliable on the daily time frame. But as I say, you can use the 1-2. It can work if you're looking for a particular entry point on a particular market. Then why not use the 1-2 as a potential entry setup for your market that you're looking at? Okay, a little bit on money management. I would say if you're trading 1-2, or if you're trading any trading strategy that you employ, it's always a good idea to try to keep your trade risk constant as a percentage of the cash you have in your account. In other words, don't keep changing your trading size too much on every trade just because you happen to like the trade. So it's a good idea to keep your risk as low and as constant as possible. So that way, if you do take a hit on one of your trades, it's not going to be the end of the world in terms of your trading account. Keep the risk relatively small. I say never risk more than 2% of your account on any one trade, but everybody has their own threshold for risk. I trade some very large accounts where my risk is 0.1 or 0.2%, my maximum risk. I've also traded on behalf of clients who are happy to risk up to 5% on any one trade, which can be a little bit hairy at times. But everybody is very different in terms of their risk tolerance level. Obviously, the higher risk that you place on any one trade, the higher the reward you're going for. So it's good to know that even the best traders or systems or gurus or strategies, whatever, will suffer drawdown periods. What is a drawdown period? A drawdown period is a series of losing trades, not necessarily in a row. You could have 3 in a row, then a winner, then another winner, then 3 more in a row. And that could be a longer series of losing trades. So drawdown is literally the amount of cash that you are down before you start to make money again. So even the best traders can suffer drawdown periods, a series of losing trades. So a drawdown period has to be allowed for as part of your trading plan. So when you go into a trade, the amount of capital that you're placing at risk should be small enough that if you happen to have a losing trade, it won't be the end of the world. And the kind of closing message I would say would be patience. Be patient, wait for the traps to form, because there's always another opportunity. And invariably, most of the best opportunities, as I said at the very beginning, tend to form after the market has formed a trap. So we're waiting for a trap to form, and that's when we pounce and we make our entry in the direction of the trend most of the time. Okay. At this point, what I'd normally do would be to do some questions, but what I want to do is just flip across to the CFI platform just to show you a few examples of 1-2 in action recently, just to show you how real the setup is. Just 1 second, sorry to, let's move across. So if I share my screen, I show you the CFI platform like so. Okay, so what we're looking at here is obviously a chart, a daily chart of euro dollar. And I've just highlighted a couple of a few 1-2 setups of recent. So what we've got here, if you recall, is the setup forms when the market makes a higher high and a higher low for the first time in its sequence. Okay, so what happened here, this blue arrow here is a higher high and a higher low. This bar did not make a higher high and a higher low, so this was the first one in the sequence. So that sets us up for a sell if we break through the 2-bar low, which we did here. This is the lowest low for the last 2 bars right here. So that's the sell trigger. So again, double thrust, 1, 2 consecutive days where the market closed below the previous bar's low. 2 more examples here. The market at this point is trending higher, double thrust, 1, 2 consecutive days where the market's closing above the previous bar's high, correction, lower high, lower low. There's the 2-bar high, that's the buy trigger. We get this big push to the upside, could have made some money on the upside there, but by the end of the session, the market was down. So some selling pressure came out here. But there was this profit opportunity from the long side here for the day trader at least. So then the market saw a big sell-off, double thrust, 1, 2, close under previous bar's low, close under previous bar's low, 1, 2, time for the turn. Okay, so bearish environment, but oversold. Market turns, makes a higher high and a higher low, sets us up for the sell, which we get here, boom, 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 triple thrust, market turns. Okay, so that's just to give you a bit of a, to show you how 1-2 worked on a few occasions on euro dollar. Another good one I think has been crude oil. This one lately, we've seen a few good buy examples. Obviously, the market's been in an uptrend for a while, but to get you into the uptrend after corrections, the 1-2 has been quite good. So this one here, after this big long consolidation here, market makes a lower high and a lower low. There's the 2-bar high. That's a buy trigger right there. So a lot of opportunity to make a bit of money on the breakout. And then the market eventually tops out, lower high, lower low. There's the 2-bar high, the blue line, buy trigger. Up it goes. Bit of chop. This one also was a 1-2. So lower high, lower low. But then there's the 2-bar high there. So you got in a little bit late, but you could still have made some money on the Brexit, break and exit. Still would have made a little bit of money on that one. Now, interestingly enough, where we are today, we're getting pretty close to a 1-2 buy setup for another crack at the long side in this uptrend. So what we've had is the market, big thrust to the upside, 1, 2, double thrust there, turn, correction. There's the 1 down, lower high, lower low. And here we are today pushing up against the 2-bar high. So we're pretty close to a buy signal on crude oil. And again, we'd be looking for another thrust to the upside to make new highs, hopefully. So this one is watch this space. We're pretty close to it. Okay, so that's pretty much all I have to say on 1-2s. Are there any questions at all? Any questions at all? No, I don't see any no questions at all. Okay, not a problem. Okay, well, thank you very much indeed for watching, participating, and I hope to see you next week. All the best. Thank you. Bye-bye.